Is FitLife Brands the little supplement brand portfolio that could? So I'll help decode that introductory statement throughout this content. But on August 14th of 2024, FitLife Brands updated the public markets by releasing its 2024 second quarter earnings report. I'll be utilizing the information included in those financial documents along with notes I took while listening to the earnings conference call. And finally, any relevant publicly disclosed information to obviously update you on the recent performance of the FitLife Brands portfolio, but also utilize everything to provide further context for my expanded strategic commentary on trends that are happening within the nutritional supplement space. For those new to these quarterly content pieces on FitLife Brands, the supplement brands that are within that portfolio are categorized into three segments: legacy FitLife Brands, which is broken into two sub-segments; NDS products, which are a collection of brands mostly sold in the GNC franchise system; and isotory products, which are a collection of brands sold through a diversified retail mix. And then Mimi's Rock Corporation products, which are a collection of brands mostly sold on Amazon; and then MusclePharm. In total, the FitLife Brands portfolio is sold through more than 20,000 retail locations globally. But let's dive into some of the financial data. In the second quarter, FitLife Brands had revenue of $16.9 million, which was up 15% year over year and up around 2.5% on a quarter over quarter sequential basis. But though that year over year growth rate obviously looks strong, it's important to remember that those reported results were greatly impacted by the MusclePharm acquisition that closed in October of 2023. But let's now talk about the sales channel mix of FitLife Brands, as it's been a major focus of the company's leadership over the last 5 years. Historically speaking, aka legacy FitLife Brands, these supplement brands generated most of their revenue from the specialty supplement retailer GNC. And by most, I mean like close to 80% at one point. But that key customer risk was constantly more problematic because of the seemingly episodic business troubles that GNC has experienced over the last decade. Now, consider that in the second quarter of 2024, GNC made up about 57% of legacy FitLife Brands revenue and only 23% of the entire portfolio's revenue. The diversification of the legacy FitLife Brands segment has come from additional focus being placed on e-commerce. Additionally, consider the legacy FitLife Brands. We don't want to kind of step on the GNC franchise's playbook that avoids channel conflict by pricing products higher on Amazon, and that segment revenue diversification effort should feel a bit more impressive. Moreover, after acquiring the Amazon-focused Mimi's Rock segment, FitLife Brands would now actually be considered a digital-first supplement brand portfolio, with e-commerce accounting for about 66% of this quarter's total revenue. And just to close the loop on this sales channel detail for FitLife Brands, online revenue was $11.2 million, an increase of 13% year over year, and wholesale revenue was $5.7 million, an increase of 18% year over year. But again, the entirety of that growth in both sales channels came from the non-comparable timing aspect of the MusclePharm acquisition. But let's next shift into some additional segment data detail for Mimi's Rock and MusclePharm, which might help provide further context into the FitLife Brands growth story. In the second quarter, Mimi's Rock revenue was just shy of $7.5 million, declining 2% year over year. Though the revenue decline seems to be coming from the skincare brands that make up less than 10% of the Mimi's Rock segment. It was noted that after the acquisition last year, FitLife Brands has been optimizing performance of the skincare brands by exiting several countries and raising prices in other countries, thus causing a substantial amount of unprofitable revenue to be eliminated. Alternatively, the Dr. Tobias brand that represents the remaining 90 or so percent of total sales increased revenue 4% year over year. This positive result happened even with FitLife Brands substantially cutting segment advertising spend by 23% year over year. It was also noted by leadership that the Dr. Tobias subscriber count grew 8% year over year, which is a really positive data point considering that subscription numbers were largely stagnant for more than 2 years. Then MusclePharm revenue in the second quarter was about $2.7 million. And if you were wondering about year over year comparatives, let's just say that the Eric Hillman run bankrupt version outsold this current version, but it's probably an apples to oranges comparison because Eric Hillman was focused on survival by any means necessary, and FitLife Brands is attempting to make strategic business decisions that support and optimize long-term growth. That being said, MusclePharm revenue did increase 27% on a quarter-over-quarter sequential basis. While the sales channel mix of MusclePharm is approximately half from wholesale customers and the other half from e-commerce, it's very likely the brand's biggest long-term opportunities will come from the offline retail side. Currently, FitLife Brands has been reestablishing relationships with MusclePharm's existing and previous wholesale customers, but that takes patience and the ideal product mix to fit wholesale channel partners. In terms of online revenue growth, MusclePharm slightly outperformed wholesale, which makes sense as FitLife Brands controls more of its own destiny in terms of pacing commercial strategy on a marketplace like Amazon. In fact, MusclePharm has been able to reach the same number of Amazon subscriber count in 6 months that required legacy FitLife Brands more than 2 years. Yes, MusclePharm is obviously a much more well-known brand than any of the legacy FitLife brands, but some of the success could be attributed to FitLife Brands increasing above-the-line promotional activity and below-the-line advertising spend. While support was provided to both sales channels, my assumption points me towards digital getting more allocation because it provides greater impact across today's consumer purchasing journey. Finally, the most notable aspect of this earnings report compared to the previous two didn't come from the increased segment level financial data provided by FitLife Brands, but because of what CEO Dayton Judd didn't say about MusclePharm. Maybe everyone didn't catch this, but he had a much more cautious, even reserved vibe when talking about the MusclePharm outlook and associated strategic plan. Yes, he disclosed that FitLife Brands would be disappointed if the MusclePharm run rate hadn't doubled over the next 12 months, but that's still very conservative. And that's because the last 5 to 7 years of MusclePharm brand mismanagement has provided a sizable amount of unlocked value that's just waiting to come out. But even saying that, I still believe wholeheartedly that the chance of getting back to the heyday of MusclePharm from both the influence, impact, and revenue perspective is a statistical anomaly. Though reaching that $20 million run rate, which is double the current run rate, is almost a kindergarten level goal. That being said, I'd rather leadership share lower ambitions publicly and drive higher ambitions internally to outperform expectations, compared to talking about launching high risk, high reward product categories like RTD beverages that FitLife Brands honestly doesn't have any applicable knowledge of historically and would honestly be a corporate strategic misalignment without major shifts. FitLife Brands should be strategically conservative for at least the next 12 to 18 months to rebuild the foundation for future growth opportunities at MusclePharm. So that strategic game plan should be focused on winning with energy and protein powders only that are sold mostly on Amazon and online, but within select specialty retailers and maybe even a few of the easier international markets. Then market feedback will tell you when to extend those energy and protein powders into platforms across different form factors and additional sales channels. In the meantime, FitLife Brands should be doing the hard work in rebuilding connection and trust with customers, reconstructing the brand story, and rebuilding community and bringing it all to life with engaging layers of content. MusclePharm is currently the most significant organic growth opportunity at FitLife Brands, but it can also be what creates unnecessary burden, especially margin-wise, on the entire company. Investing in brand growth through promotional offers or increased digital advertising spend is necessary, but FitLife Brands needs to ensure it doesn't get overly aggressive trying to restore MusclePharm back to a level it will never reach again. That being said, I'm quite confident FitLife Brands understands it's a marathon and not a sprint with MusclePharm. So where can FitLife Brands find easy growth in the next 12 to 18 months? Even with 2 sizable acquisitions in the last year, FitLife Brands is already generating enough free cash flow to feed overall portfolio growth and simultaneously reduce its indebtedness. Moreover, I think integration of these deals are almost at a sufficient phase that FitLife Brands can pull the trigger on additional acquisition opportunities. Here's the good news about the supplement industry. It's highly fragmented with a collection of relatively good brands that are mismanaged operationally or financially. That provides a great upside opportunity from market consolidation, and FitLife Brands leadership has already publicly stated it's currently electing to build cash as it continues to evaluate M&A opportunities. And I know this is probably the time when I usually make some M&A predictions, but I'm going to hold off on that for now until I get a better understanding of the FitLife Brands investment criteria. But I hope you enjoyed this YouTube video. If you did, consider hitting that like button to support me. Also help me get to my new short-term goal of 4,000 subscribers by hitting that subscribe button. I'd love to see you join me on this journey. We need to fix the fact that just slightly over 90% of you that are watching this YouTube video right now are not subscribed to my channel, and that makes me extremely sad. But I do want to thank you for tuning in, and I'll see you on the next one.